Today we're going to cover 2025 Medicare premiums, how a little-known factor called IRMAA could end up skyrocketing those premiums to the tune of thousands of dollars per year, in addition to what those IRMAA bracket surcharges are, and 3 strategies that you can consider when building your plan to try to avoid IRMAA altogether. My goal here is to arm you with the information to make an educated decision when you're going about your retirement planning, because all too often we find retirees are caught off guard by these additional expenses. Quite frequently, actually, when I come across these types of discussions with clients, I find that they often think that Medicare comes with one flat price tag. Essentially, you sign up just like everybody else, and that's it. You're good to go. But unfortunately, that assumption doesn't always hold up to be true. And in fact, your premiums could end up being 2 or 3 times higher than your neighbors. And it all boils back to your reported income. Nothing to do with your health. So let's break this down for a minute. In 2025, the standard Medicare B premium is $185. But with the highest IRMAA surcharges, that premium can actually escalate to about $600 a month. Same coverage, same doctor visits, nothing extra. The only thing is, if your income is higher, you can expect that you could end up paying higher premiums. To put this scale into perspective, a married couple with modified adjusted gross income above the IRMAA thresholds to the upper end of the limit could end up paying about $12,000 more than a family with income lower than the IRMAA limits per year. When you multiply that outcome over several years, it ends up becoming quite hard to ignore. And normally, Medicare Part B is subsidized, so the government ends up paying about 75% of the total cost, while the beneficiary ends up footing the bill for about 25%. But with this great thing called IRMAA, unfortunately, higher income earners have to pay more than that 25% portion of the bill. In other words, although this surcharge is framed as an additional contribution to the system, it could end up acting like some sort of a stealth tax for retirees caught off guard. Now, as I mentioned earlier, there are multiple times that we come across per year where retirees are caught off guard by this situation. It's actually estimated that between 4 and 5 million Americans are hit with IRMAA surcharges annually. And while some have planned very carefully and diligently for their taxes and investments, they might not have planned for these IRMAA surcharges as far as their withdrawals in retirement are concerned. With that, I find it very important, in my opinion, to understand this next piece of the puzzle. These potential surcharges are not necessarily based on your current income, but rather on a 2-year look back. So, for instance, your costs for 2025 would be based off of your modified adjusted gross income for the year 2023. And this 2-year look back isn't just a one-time adjustment. It occurs on a rolling basis. So your 2026 premiums will be based off your 2024 income, and your 2027 premiums will be based off your 2025 income. Now picture this. You finished out your working career in 2023, earned your full salary, and stepped into retirement in the beginning of 2024. By 2025, your income may have dropped substantially, where you have modest Social Security checks, and you're drawing just enough to keep you going from your investments. But Medicare does not care, and they still charge you based on your 2023 income. The same issue can hit if you've had a one-time spike in your income during that year 2023. Whether it occurs due to the sale of a home, or maybe the liquidation of a business, or even a large withdrawal from any pre-tax retirement accounts that occurred during that year. Any of those could potentially impact your IRMAA surcharges for 2025. Knowing that this could be the case, and understanding it, can put a real emphasis on the timing of your withdrawals and where you pull money from in retirement. Fortunately, on the flip side, it's also important to note that you aren't stuck paying these IRMAA surcharges in perpetuity if things should change for you. Medicare does allow for adjustments to be made over time if your modified adjusted gross income were to fall below those IRMAA thresholds as well. For instance, if your retirement income was cut in half, or if you experienced a life event that significantly impacted your income in some fashion, there are ways that you can challenge the numbers. So understanding how and when to respond can also potentially be helpful for you. Because in some instances, we find that retirees think that they are stuck in paying those IRMAA surcharges year after year, no matter what. And here's where the next part of the discussion comes into play. Because while the 2-year look back sets the baseline, you're actually able to provide instances and proof of where your income might have dropped dramatically, therefore potentially allowing you to pay less in those IRMAA surcharges. In the event you experience a qualifying life change that dramatically reduces your income over time, you could end up filing a Form SSA 44, whereby you're requesting that Social Security recalculates your premiums. And although not every event qualifies, Social Security does recognize a certain set of events, which could include things like divorce, death of a spouse, significant decrease in work and the ability to earn income, or even the loss of a property producing income. These are all sets of circumstances where your financial picture might have materially changed, and the system could allow for recalculation. And be prepared, more than likely you're going to have to gather documentation if you choose to go this route. This could include things like an employer's retirement letter, a pension settlement, in the case of a spouse passing, a death certificate, or even a signed and amended tax return. Social Security needs verification that one of these qualifying instances actually did occur and your income decreased as a result. Without evidence, the system can default to assuming your old level of income, which could include those IRMAA surcharges. And while this appeal process could potentially take some of the sting out of this situation if you do get hit with these IRMAA surcharges, let's explore some of the steps you can take to be proactive in trying to avoid them altogether. One of the main factors we consider when planning for clients is trying to design their retirement income flows in a way that keeps their modified adjusted gross income below the IRMAA thresholds if possible. In a broad sense, I focus on 3 specific categories. The first of which being Roth conversions, whereby you convert pre-tax dollars to Roth accounts, paying tax in the immediate in an effort to potentially reduce income down the road. And while the conversion itself counts as income in the year that it occurs, there is the potential to lower those pre-tax balances going out into the future in comparison to what they could have been otherwise. And if we're deciding to implement these conversions over time, something that we do look at as far as dollars and cents are concerned is the potential benefit to one by creating these Roth conversions as opposed to the IRMAA surcharges or potential for IRMAA surcharges that they might face. The second tool to consider is a qualified charitable distribution, or a QCD. For folks age 70 and a half or over, this allows you to send a portion of your retirement withdrawals from pre-tax accounts to a qualified charity. And if you're of the age where you're currently taking required minimum distributions, these QCDs can count towards the RMDs for that current year. For 2025, that number is $108,000 per person, and that would not be added to your modified adjusted gross income. To illustrate this, let's say this year, in 2025, I am 75 years old and I have an RMD of $70,000. Rather than taking that money out and adding it to my modified adjusted gross income for the year, I choose to make a qualified charitable distribution of $70,000, whereby I donate the money, it does not get added towards my income, and hopefully I can skirt by and stay under those IRMAA thresholds. The third tool we use is understanding when and where we are going to take certain withdrawals from in retirement, in addition to when we are going to establish Social Security by intention as opposed to by default. In some cases, planning which accounts you're going to take money from first in retirement can have a direct impact on your tax situation. For example, making withdrawals from non-retirement oriented accounts or smaller withdrawals from pre-tax IRA or 401k type accounts could end up resulting in a less volatile modified adjusted gross income over the course of time. Similarly, delaying or accelerating when to take Social Security could also end up making a difference as to when those taxable benefits hit your bottom line. Precision here can be imperative because the IRMAA brackets operate like cliffs as opposed to gradual slopes. $1 under the threshold and you can stay at the base premium, $1 over the threshold and now you have a bump up in cost. I like to think about sequencing income as more of a rhythm as opposed to a one-time event. In some cases, we find retirees opt to take money first from their non-retirement accounts in an effort to keep their taxable income lower and then end up taking money from their pre-tax accounts down the road when the Medicare situation might be more predictable for them. Alternatively, some retirees might choose to map out Roth conversions between the year they retire and before they hit Medicare age in an effort not to collide with those IRMAA cliffs. The common theme between these two situations is that they are coordinated, intentional choices, not just following things as they go. And the broader point here is that these surcharges can potentially provide a sense of predictability. A positive here is that the brackets are published in advance. And while everything can change over time, working with a team of trusted professionals could give you a shot in making more informed decisions. And in my opinion, this is where the bigger realization begins. Our approach to retirement isn't just about tax efficiency or portfolio growth. Each decision can tie into another. So it's important to understand how these situations and choices could potentially intertwine in addition to what the ramifications could be of said choices. When working through the planning process and considering things like Roth conversions, qualified charitable distributions, or even income planning in general, it's important to understand that everybody's situation is different. And while investment returns and markets in general can be unpredictable at times, understanding things like tax planning, healthcare and Medicaid planning, and even estate planning reviews are all pieces to the puzzle that we go over with our clients. Rather than looking at retirement as one snapshot in time, we look at it as a journey that presents all sorts of twists and turns. And if you're unsure what this can mean for you, don't hesitate to reach out to our team. We've helped hundreds of families plan for retirement through the course of the last 10 years, and we pride ourselves on being part of their big picture. And as a side, if you're currently working through your tax planning for 2026, check out our next video here.